Well, folks, the chatter is starting. Did we just start? Are we in the first inning of the next stock market crash? Now, at this point in time, a very similar phenomenon to what we saw in 2008. I prepped a lot for you guys in this one. We got a lot to go through, good, bad, everything in between in regards to this video. Apple stock obviously is starting to get hit heavily. Apple's the biggest market cap company in the world. Some would say it's the most important stock in the entire stock market. Just in the past 5 days, this baby has dropped 6%. And the most important stock for the stock market this particular year is this company in front of you right now, NVIDIA. There's no more important stock in 2023 than NVIDIA. This stock has now just dropped 7% in the past 5 days. And so we have a very interesting phenomenon that's very similar, like scarily similar to 2008, that a lot of people are drawing parallels to. And they're saying, this market we're going through, this is exactly like what happened in 08, where things are just about to massive deteriorate and we're going to have an epic crash. So I want to run you through the scenarios, want to run you through kind of what I'm up to in the market, kind of how I'm approaching this, thinking about this moving forward, and show you a lot of important charts, data, and information so you can hopefully make the most informed decision for you and your family. So appreciate everybody joining me as always. Thanks so much for being here. Thank you for being subscribed, folks. Got a lot to go through in this one. Okay, so a lot of people are looking at this recently, okay? So if you were in the market the past few years, you experienced the 2021 highs, the blow-off top situation coming out of the Rona crash, right? 2020 into 2021, and then we had the vicious, obviously, drop in 2022, and then we've had this, insane kind of comeback this year, specifically in the first half of the year for the market overall, right? And we'll zoom in on this in just a moment. This is a very similar phenomenon to what we had in 2008, where we had kind of a blow-off top into a big drop, into a recovery where the recovery did not get back to where we previously were. And then we had an epic drop from there, an absolutely vicious drop where things just got worse and worse and worse and worse and worse, while the government said it would not get worse. The Federal Reserve said it would not get worse. We weren't going to have a recession, nothing like that, right? The President of the United States said that. And boy, did it get bad, and boy, did it get bad fast. In a matter of 12-month span, things deteriorated so much more quickly than really anybody had anticipated, right? And so people are wondering, are we about to have this sort of drop, okay? Now, let's zoom in on what happened back in 2008, okay? So we had the blow-off top, and that could be seen as kind of like what we had in 2021, right? Now, then we had a major drop. This could be seen as kind of like what happened in 2022 in the stock market. In, kind of 07 into 08, it wasn't quite as bad as it was in 2022. We actually had even a bigger drop in 2022, believe it or not, than what we did in kind of this 07, mid 07 to early 08 time. Then you had a comeback in early 08, okay? And things were looking pretty good. A lot of people were like, oh, this recession talk, this is overblown. We're not going to have this recession. We're going to be just fine, right? And this could be seen as our first half of 2023, right? Where a lot of folks are kind of like, it looks okay out there. I think we'll be fine. And the market just kind of went up in almost a straight line, very similar to what we've had in the first half of 2023, right? Then we had the first inning drop, right? Little comeback. And then we had just viciousness for the next 9 to 12 months. Absolutely brutal market for that next 9 to 12 months, right? Where the indexes just fell off a cliff nonetheless, right? And so this is a very similar parallel that people are drawing to what we're going through recently in the market, where, it's looking great, then it's looking horrible, then people are like, oh no, consumer's fine, we're not going to have a recession, everything's going to be okay, and then suddenly you get a massive drop, and are we at the beginning innings of that, right? So I want to say this first off, okay? We're in a bad situation, a very bad situation for a potential of any sort of major recession. And the reason we're in such a bad situation is S&P 500 large caps are trading actually very rich compared upon historical standards right now. It's another situation you want to see. Even in the 07 into the 08 crash, we did not have large caps trading up where these stocks are trading at right now. Back in 07 into kind of 08, you were trading at roughly like 15 times, 14 times on S&P 500 large caps, right? Recently, we've been trading 18, 20. That's not an ideal situation. I can tell you that with the risk we have out there in the market, right? Small caps, mid caps, those have been kind of trading in undervalued ranges for honestly probably about 2 years now at this point in time. It's been a while. But let's not fool ourselves. Mid caps and small caps don't matter to the overall stock market. to the indexes. Large caps are what matters to the overall market and indexes. So if we're talking about a major recession that really hurts these sorts of companies in any substantial way, when they're trading at very rich valuations, that could mean a substantial amount of pain for the indexes. It's just a question of, is it a 30% pain, 20% pain, 40, 50, or 60% pain for the indexes overall, right? Now, in regards to the economy and what's been holding things up, we had a phenomenon, right, where in 2020, 2021, we had the shutdowns, everything like that, right? And basically 2022, 2023 was a consumer going back out in the world, spending like, crazy, let's just call it like that, right? And basically the consumer holding the whole show up, holding the whole economy up, holding employment up, all those sorts of things by kind of this revenge spending of 2022 and 2023 in general, right? I mean, if you think about what's happened over this past, let's call it 18, 24 months, concerts, restaurants, vacations, weddings, all this stuff, massive spend, a lot of employment, right? These industries employ a lot of people. It's incredible, right? I mean, the concert thing alone just blows my mind. I mean, it used to be a huge deal if you were a musician and you had a concert at an arena, right? That fit like 15,000 people. That was a huge deal. And I got some, pictures here from you guys at the Beyonce concert. So shout out to you guys that were at the Beyonce concert there, okay? Crazy. Like now you got to do a stadium. You got to have 60, 70, 80,000 people. Like this just seems insane, right? I got some nice pictures of you guys at the Taylor Swift concert here. Shout out to you guys that are, the Swifties out there. Man, did you guys spend a lot on that Taylor Swift tour. Holy smokers, that was no jokers, right? And, everybody just going out there again in these concerts and just spending fortunes of money, right? I mean, absolutely insane. And that's just one part of it, right? Just one part of it. The restaurant industry has been booming this past about almost 2 years now at this point in time, right? Once kind of the shutdown started to end, boy, did the restaurants boom, right? This is a 10-year performance between the restaurants and retail. And you've really never ever seen a divergence this massive between the restaurants and the retailers, right? Which is just people wanting to go out there, do stuff, right? Oh, let's go out to the restaurant tonight, right? The most insane divergence you've pretty much ever seen. The only time period you've really seen any sort of divergence like this is right before Rona crash, which is quite interesting as well. Usually these are roughly in line with each other, but this sort of divergence definitely tells you you're going through something unnatural in the economy and in the stock market in general, and that's probably not going to last. That sort of massive, epic divergence there. Very, very strange, let's just call it that, right? Travel. We know travel's been insane, right? Everybody was cooped up in their homes, 2020, 2021, and then 2022, 2023, everybody's like, let's go travel. Nevada, gaming revenue hits an all-time high in July, boosting the state fund, right? I mean, Vegas has been on fire. And I'm not talking about the weather, okay? The business climate in Vegas has been phenomenal. 2022, 2023, you couldn't ask for more. Record numbers, absolutely incredible, right? And so travel's been insane. Even international travel has been insane. International travel's really, let's just call it, got up to my baby came and paid me a visit. Hold your horses. There's a baby here. What do you want to say to the people? What do you want to say? Oh, he said, no. He said, don't short the market. So what you had is obviously 2022 being a massive year for domestic travel, 2023 being still huge for domestic travel and international travel, right? And the revenge travel is obviously on. By the way, thank you everybody that obviously comes to Vegas, because I appreciate y'all, because that's the only reason we pay no state income taxes here. So I do appreciate everybody that comes and has a good time in Vegas, okay? Brides and grooms, a record year, okay? 2022 last year was an insane year for weddings, obviously, right? Some 2.5 million weddings in 2022, the most since the 80s. Holy smokers, that's no joke, because everybody, I guess, wants to get married in 22 and 23, right? Because you didn't really have weddings going on for the most part in 2020, 2021 with all the shutdowns. People were so unsure about, if we were going to have more shutdowns. So it wasn't like you were going to plan out some huge wedding and invite people, all to come to your wedding. That just was unrealistic, right? By the way, for the people that are getting married, have some kids too, okay? I know a lot of people with a lot of money, they don't have any kids. Like, who are you going to give all your money to when you die, man? Like, come on, think about this for a moment, right? Now, here's the problem. U.S. consumers are done splurging, Fed reports suggest. So we've had this insanity of spend and spend and spend, and it looks like it's starting to come to an end. After a summer of robust consumer spending, America's bars, hotels, and restaurants say the era of post-Rona splurging by U.S. consumers has likely drawn to a close. That includes revenge travel, a phenomenon in which consumers spent big on dining out and travel to make up on lost time during the Rona shutdown era, right, of 2020 and obviously 2021. The prediction came as part of the regular Beige Book economic snapshot from the Federal Reserve released Wednesday. Several of the Fed's 12 regional districts reported peaking or even slowing tourism activity, a sign that U.S. consumer spending, which accounts for about 2/3 of U.S. economic output, oh my gosh, could be shifting in the coming months, right? So this is where things start to really get interesting here, right? But those headwinds might not take much wind out of the sails. Wall Street bankers and Fed economists recently reduced their expectations of a recession based upon the U.S. economy's remarkable resilience the past few months. Just this week, Goldman Sachs lowered its odds of a U.S. recession over the next 12 months to 15%. 15%, down from the prior forecast of 20% and well below its 35% projection back in March amid spring turbulence in the banking sector, right? So here we have another interesting phenomenon that all of a sudden Wall Street is starting to throw in the cards on recession. Goldman Sachs down to only 15% chance of recession in the next 12 months. Bold prediction there, Goldman Sachs. Interesting. And but this is the same thing we saw prior to 08, right? The same exact thing. Most Wall Street folks were not expecting some sort of epic recession in 2008. They weren't. The Fed was not expecting some sort of epic recession into 08, right? Like you go back to what the expectations were in 2007, most people were expecting good things, right? The government officials, President of the United States, and next thing you know, by the time we get to late 2008, everybody is well aware that we're in a recession and it's tough times, right? And that goes for the Fed, that goes for the president. Remember, the President Bush goes on TV, says, folks, unfortunately, we're in a bad economic time. We're in a big recession. Like, that's what happened. It happens quick. It happens quicker than a lot of people anticipate. In a matter of 12 months, a lot can change, right? Just look at the stock market. Just look at growth stocks, for instance, over the past 9 months or so, right? Look at where growth stocks were at October 2022 in the sentiment around those stocks, and then look at where the sentiment was around those stocks in the summer of 2023. I mean, my gosh, could it be night and day difference? I mean, hundreds of percent gains. The sentiment completely shifted on those stocks, right? So you got to understand, people's opinions change quick. The thought process changes quick, and ultimately the data can change pretty dang quickly as well. Okay, so I've always been wary. I'm like, whenever all Wall Streeters give up on the recession thing, like that's when it's actually going to freaking happen. Oh boy. Okay. Now, personally, my personal opinion on this. So it's not good. Okay, this is the United States Fed funds rate, right? And obviously we skyrocketed over the past year and a half. Now there's something that's called Fed lags, right? Which is basically how long does it take for all the Federal Reserve's raising of interest rates or lowering of interest rates to start to affect the economy in a substantial way. Now usually it takes anywhere from 1 to 3 years for this to happen. Now, a lot of people thought, okay, the Fed lags are going to kick in 2023, right? Which would have been really quick. That would have been more in the 1 year time frame, right? I would put it to you like this. Based upon my 15 years of study of macroeconomics and all this money-related stuff, I would put the odds of the Fed lags catching up in 2024 at about a 70% probability, folks. And I'd put it at about a 90% probability that the Fed lags catch up with us either in 2024 or 2025, which is almost a guarantee. The Fed lags will catch up with us in a substantial way, and you will have ultimately the employment market get hit in a substantial way when the Fed lags do catch up. Because when they catch up fast, and then they're very painful. And then the Fed starts, guess what, lowering interest rates, but that doesn't always bode well for the stock market in the short term. Over like a year later, that might bode well for the stock market. But when the Fed just starts lowering interest rates, it's clear there's distress happening, there's problems happening, and it's clear like usually earnings are going to be far less better than what they are, and valuations should command much less of multiples in some sort of scenario where the Fed's cutting rates. So those are some things to kind of keep in mind here. Fed lags are going to catch up with us. It's nothing's guaranteed in this game, but I live in Vegas. You put odds on everything. 70% chance Fed lags catch up with us in 2024 at some point in time, right? Now, When the Fed lags catch up, it's going to be a problem, right? And by the Fed raising interest rates the way they have done, basically, it's already caused, I would say, moderate stress on the banking system, okay? Now, we've seen this play out with some of the banks already, SVB and a few of the others that went under, obviously, back in the springtime, right? But if we have a few scenarios happen, we're going to go from moderate stress on the banking system, where most banks can withstand the stress that's on them, to a situation where it could get far worse, far faster, okay? With the Fed having rates where they're at right now, right, and the Fed lags eventually catching up with us, if we see unemployment going up in any substantial way, and the amount of loans not being paid go up in any substantial way, which we're already getting indications that credit losses are starting to go up substantially. If you look at any of that sort of data, it's already getting pretty worrisome about, kind of where we're at with credit losses and that whole movement as well. So we're already getting the early signs that there could be some weakness there, and that's even with an unemployment rate in the 3s. If we have an unemployment rate go to the 5s or the 7s or the 9s, oh boy, okay, loans will start not being paid back in a massive way. I'm talking auto loans, I'm talking credit cards, I'm talking all that stuff, right? If that's a phenomenon that plays out, obviously you're going to go either to high stress in the banking system or max stress, right? Max stress was what we had in 08, 09, where you had literally everything being problematic, from auto loans to obviously mortgages and what happened with the housing crisis. I mean, credit cards, it was the max level mess. There's a potential we could avoid a max level stress test on the banking system and maybe just have high stress. If we have high stress, we're still going to have a lot more banks go under. And I mean a lot more. But it won't be as severe as what we had in 08, 09, where it seems like it's decimating almost every bank, and you need just a ridiculous amount of bailouts we had during that era, okay? So do keep that in mind. If unemployment goes up in any substantial way and these loans start to not be paid back, I'm telling you, we're going to go to high to potentially max stress in the banking system. That's going to be very bad. And the reason that's going to be very bad is that leads to a problem that's called credit crunch. When you have a credit crunch, you're screwed. That's the best way to put it. You're screwed, okay? Because here's the bottom line. The U.S. economy is run on credit, okay? How do you think people are buying all these cars? You think they're buying them with cash? No. How do you think people are buying all these homes? You think they buy them cash? No. They're buying them on debt. How do you think people pay for most stuff? Credit cards, right? So if you have any sort of credit crunch, when a company goes to, let's say, have some sort of big infrastructure project for their company and spend a bunch of money, what do you think a company usually does? They take out a loan from a bank, right? To go basically make that deal happen. If they're going to buy out another company, they're going to finance it usually, right? Refinancing a debt as well. If you have a credit crunch, you have a mess. And it's the worst thing that can possibly happen in the U.S. economy is a credit crunch. If all of a sudden that person that usually could get that auto loan can't get that auto loan anymore, you got a problem. If the family that wanted to go buy a house can't buy a house because we're in a credit crunch, it's a problem. Okay, if the person that had $10,000 credit card limit goes down to a $1,000 credit card limit, we got a problem. It might be healthier stuff long term, but in the short term, that's devastating because that just means far less spend. Far less spend means far less jobs. Far less jobs mean more far less jobs. More far less jobs mean company earnings worse. Company earnings worse mean lower valuations. It's all dominoes, folks. It's all dominoes. And so if we get into any sort of credit crunch, you better believe the market is going to be nasty if we get in that situation. That's not a guarantee. In order to have a major credit crunch, you're going to need max level stress on the banking system, something similar to what we had in 08, 09, to get a real, true, massive credit crunch. You could have a minor credit crunch if we have just kind of high stress in the banking system, and that would still hurt the economy, and that would still hurt the stock market and earnings in general, but it wouldn't be what seemed like end of the world type credit crunch like we had in 08, 09, okay? Now, the stock market's been doing phenomenal, really, in 2023 specifically, right? Dow's held up very well, done actually pretty good this year. S&P 500's done well. I mean, if you could get the gains S&P 500's had this year, you'd take those every year, right? NASDAQ's done obviously phenomenal this year. And what the stock market is basically a confidence gauge for everybody in general, right? And if we have any actual weakness in the actual stock market, you're going to lead, especially when it comes to S&P 500 specifically, right? Because so many people are in S&P 500 index funds, something that mirrors that. Then the confidence goes down, right? As soon as people's 401ks start going down, in retirement accounts. Because remember, most people are not like you watching this video 20 minutes in, okay? And you care a lot about the markets and stocks and your portfolio and all this stuff. Most people are not like you watching this video right now. You're like the 1% of the 1%, okay? Cool. I appreciate you, okay? You're like me. But I'm telling you, most people are not like that. Most people don't look at any of this stuff most of the time until every once in a while they open up and they see what their 401k's at, their retirement account. And if suddenly their retirement account says $80,000 instead of $105,000, they start saying, what the hell's going on with the stock market? What's going on? Is the economy about to get bad? And that kind of starts to have a little bit of a panic in itself, and people start pulling back more and more, right? We saw a little bit of that in 2022, but not to as big of an extent as you might have thought, right? Because of how kind of quickly the market came back there, and the S&P 500 didn't get hit nearly as hard as the NASDAQ. If the S&P 500 gets hit hard, believe me, people will wake up quick. And next thing you know, everybody's going to start paying attention really quickly, okay? And all of a sudden, mainstream media starts picking up on it. It becomes a big news story. It becomes trending, all those sorts of things, okay? So we'll see how all that shakes out. But I'm just telling you, like, this is a big confidence scorecard, okay? And if that gets hit, then confidence in general is going to get hit quite significantly, right? Now, we also have an interesting phenomenon that's going on, which is, I'm sure you guys have seen some of these deals recently, the UPS deal. You got, obviously, the United Auto Workers deal that's potentially going through. The United Auto Workers president just today called GM's offer insulting ahead of a strike deadline that's a week away. So we're in an interesting situation where workers are demanding, obviously, wage increases, and quite substantial wage increases, not like 1%, 2%, 3%. We're talking about big wage increases. But companies are now starting to have trouble offsetting the increase of wages to the consumer because the consumer is being hit really hard, right? So that's where you get into this potential of stagflation, which no one really wants to see, but there's an argument being made that maybe we're starting to slip into stagflation, from inflation to stagflation. U.S. stagflation risks rise as service sector falters alongside manufacturing downturn. Growth of business activity in the United States came close to stalling in August, according to the final reading of S&P Global's U.S. PMI. Looking at the broad split of data, manufacturing output slipped back into decline after a brief resumption of growth in July, right? Now, if you watch Mav and ever hear his opinions, Mav's been calling for stagflation for quite some time, right? And he's one of those folks that definitely sees stagflation coming. Stagflation is not a good situation, folks. That's a situation where we have a weak economy, high prices, and that leads to, ultimately, job losses. Because eventually, companies are just getting slaughtered, and they have to start cutting jobs. And we're talking, not just talking about like the tech companies that were cutting jobs last year. We're talking about the mass, okay? The massive amount have to start cutting jobs. And they're like, dude, we can't afford to pay all these workers. They want all these wage increases. We can't afford this. The consumer's not out here buying what we're trying to sell anymore because they've been hit so hard by inflation. And you run into stagflation. It's not a pretty situation. It's a very ugly situation. It's something obviously the Federal Reserve doesn't want to see. But nonetheless, you can make an argument that we could be slipping into stagflation recently or very soon here, and that's not a good situation. Now, in order to get the stock market to really start crashing in a major way, we're going to have to start seeing unemployment start flying, okay? And, recently we hit 3.8% as a past year for unemployment rate, right? And if all of a sudden we go 4%, 4.5%, 5% in 2024, yeah, we're in for it then. Because here's the problem. And you might say, well, isn't that kind of a good news? Because that would mean all this wage pressure comes down. A little bit of good news, but it's a lot more bad news. Because the problem is when the unemployment rate starts slipping and the dominoes start falling that way, you don't know when it's going to stop. Is it going to stop at a 4.5% unemployment rate? Is it going to stop at 5%, 7%, 9%, 10%, 12%, 15%? You don't know. That was the scariest part of 0809. Was when the unemployment rate started to slip, and then it started to slip fast, and next thing you know, 4%, 5%, 6%, 7%, 8%, and it peaked at just over 9% on unemployment rate, and that's if you believe the government number. Some people don't believe the government number, so they actually believe it was a lot more than 9%. I'm not going to get into that debate or argument, but nonetheless, when you get into that scenario, it's very, very scary. And then we bottomed out the market, obviously, around March of 2009, because people felt like the worst was behind us in terms of the unemployment picture. Plus, you had the Fed starting to back things. So it was between those two that kind of bottomed us out. And then we slowly started to come back over the next 2 to 3 years. But that's a process to go through. And it's a scary, scary thing to go through, man. As somebody that was in the market in 08, 09, and I was just a little newbie beginner in that, like, I watched a lot of people, with their portfolios going down and stocks going down. And I remember watching CNBC and the panic that would come from these folks on a daily basis, seeing stocks down big and the unemployment rate keep climbing and you not knowing where the end is. That's the scariest part of that, right? And in terms of unemployment getting in a better place, usually it's kind of like walking stairs. But when it starts going down, and especially if you have a credit crunch or something happened in the banking system, it's like taking the elevator down. It happens quick, man. Okay, so you get a stair step up over time when it comes to bringing unemployment down. But when it gets ugly, it's a straight elevator drop. You saw that obviously in 2020 with the shutdowns. You saw that in 08, 09. It happens quick and it gets pretty ugly fast. And so that's a huge thing to just keep an eye on. That if we see this, we're going to be going down substantially. And I mean substantially on the market, right? Which, by the way, if you want a glimmer of good news before I get into kind of how I'm approaching this market moving forward and kind of how I'm thinking, hey, I don't know if it'd be a worse thing to have unemployment go up a little bit. Like, this whole situation is ridiculous, man. Henderson, I love Henderson, okay? I got a property in Henderson. CCSD, Clark County School District, concerned after Henderson School cancels classes due to teacher and staff shortage. They have to what country are we living in? You don't even have enough teachers and staff to run a school? Like what are we talking about here? What are we talking about? It's embarrassing, absolutely embarrassing. But that's a phenomenon we're going through in the economy where, if you want to know some good things about if unemployment went up is, man, maybe people will start to get some of these jobs again. And I think maybe schools should maybe pay teachers a little better. That might attract a little more folks because, teachers have been underpaid for 10 plus years now. And with how much inflation has gone up, I'm telling you, man, this is embarrassing, man. And how are we gonna have the next generation if we can't even have class? Like, what is going on, man? What is going on? Alrighty, so let me talk about how I'm approaching this market, how I'm thinking, how I'm moving forward, okay? Now, before I get into that, let me address one important thing, okay? Because Wall Street has mostly underperformed significantly this year in the market, right? Because most of them went into this year very bearish. The market blasted higher. A lot of people were left on the sideline saying, how the heck do I get in this thing? There's two ways they can catch their performance up to be somewhere in regards to SP 500. One way is they buy like crazy and hope the market pumps into year end. And we've talked about that on the channel before, right? But there's another way you can get there. It's another way you can get there. The S&P 500 goes down big. There's two ways of getting there to save Wall Street's butt. We don't know which one's going to play out here in this situation, but usually Wall Street's going to find a way to get themselves somewhat back in where the indexes are roughly, so their underperformance doesn't look so embarrassing to their clients, okay? I don't know which is going to be, whether they're going to pump the market like crazy and try to, race to the top, or whether we're going to get a massive sell-off here and next thing you know, oh, hey, we were smart for not being, all in the market going into 2023. We'll see what happens, but there's two ways they'll get there. And they're probably going to get there. Let's just put it that way, because they always find a way to kind of get somewhere close to the indexes in general, okay? Now, me and my approach to the market, okay? So my focus is really three places right now. One is buying dividend stocks. There's a lot of great opportunities in dividend stocks, and I'm getting ahead of this, just like I got ahead last year with growth stocks. At the end of the day, like, if we start to see that unemployment rate start to tick up in a significant way, believe me, money's going to flood into the dividend stocks. The Fed will start cutting rates, which is going to put, obviously, immense pressure on savings accounts, CD accounts, everything obviously in relation to that, right? Which, by the way, is going to be a very interesting phenomenon, because when the Fed starts lowering rates, right, all that money starts pouring out of savings accounts, CD accounts, or whatever. It's going to be leaving banks, and it's going to be looking for yield. It's going to be going into dividend stocks, in my opinion, right? But that's going to be an interesting kind of hole to fill for a lot of the banks, which is not going to be a good time if they're seeing massive outflows during a situation where, let's say, loans aren't being repaid and unemployment skyrocketing and things like that. But anyway, that's a whole subject for another day. But buying dividend stocks, definitely one of my huge focuses there. The yields are insane. The Ps are insane. The business models, many of the business models that are dividend stocks, they're going to perform well in a recession or not a recession, bottom line. Okay. I want to take healthy cash levels into 2024 overall, because I can just tell you, like, there's a lot of headwinds. There's so many things I didn't even cover in this video that I could have covered that are like black swan events that are out there. China, Taiwan, Russia, Ukraine. I mean, there's so many to get into in relation to that. Like if we have some sort of new spike in inflation, like my gosh, man. So nonetheless, I want to have healthy cash levels going into 2024. And I also need to finish out my hedges for 2024 overall, because I definitely, it's definitely a year I want to have some hedges on for the market in general. I've got a decent amount of them ready to rock and roll. I probably have a few more last stragglers to get done over this next, let's call it few months. And then I'll be ready to rock and roll for 24. So regardless of whatever the market throws at us, whether that's a big drop in the market in 24, whether that's a chilling market in 24, or whether, you know, it's a great year and the economy's fine and, you know, stocks roar, whatever the situation, I'll be prepped for that essentially. And so that's kind of what I'm looking for in 2024, because I don't think it's clear cut anyway that things are going to crash. I don't think it's clear cut that the market's going to skyrocket. And I don't think it's clear cut if things are going to be flat. I think we're in a very interesting time period, and the punch bowl's been obviously taken away by the Federal Reserve, and that makes things start to get really real, really fast. I appreciate everybody joining me as always. Thanks so much for being here, folks. If you enjoyed this 30-minute plus video I put together for you guys, and you want to give back, hey, join my Patreon. It's a pinned comment down there. You also get access to see the moves I'm making tomorrow in my Patreon portfolio, as well as every week. Plus, you get to be part of the Discord chat. I also have a Patreon tier, by the way, that also has a course attached to it. So if you're looking to access that, you can definitely access that. It will be pinned comment down there. Much love and have a great day.